Okay, thank you. Well, I just wanted to highlight, of course, conventional loans, because that's what we're here to talk about, but then also wanted to highlight some other products that kind of set Chartway apart. So, of course, the first being conventional, I just put on this sheet for you guys kind of what the minimum credit score is, which is a 620. Minimum down payment is going to be at least 3%. Mostly if you're a first-time home buyer or have limited income, you can do as little as 3%. Otherwise, if you've previously owned a home, it's going to be 5% for a primary home, and then secondary is, or second home is 10% down, and then investment properties is going to be at least 15%. Conventional loans are nice because they have a little bit more lenient guidelines when it comes to appraisals. So FHA and VHA loans have a little bit stricter appraisal guidelines. So if it's a home that maybe needs a little bit more work or has some repairs needed, conventional is usually the way to go. There's also several term options, so somebody can do anywhere from like a 10-year all the way up to 30 years fixed loan, which is nice to have those options. And then, of course, for conventional, anything less than 20% down is going to require the loan to have mortgage insurance. So just keep that in mind. And it is tiered. Like, say, if you're putting 10% down, the mortgage insurance is going to be cheaper than if you're putting 5% down, and it kind of tiers down from there. I do also want to highlight, we have a conventional 100% financing product, so there's no down payment required. The minimum credit score for that product is a 720. They do have the option for this particular product to either do a 30-year conventional fixed loan, or they can do a 5/1 ARM loan, which stands for adjustable rate mortgage. So there's two options there. The only kind of requirement that's different with the 100% financing product is that they do have to have at least 2 months of the full payment in reserves, and it does have to be their funds. It can't be gifted or borrowed. It does have to be their funds that they have in their own account. The 100% financing product is just for primary residences only, and there's the only type of home that is restricted from that is we can't do manufactured homes on that particular product. Another great option that we have is the ARM loans, which stands for adjustable rate mortgage. We do have several options as far as terms for these loans, so we can do anywhere from a 3/1 all the way up to a 10/1. So what that means is it's a 30-year mortgage loan, but the interest rate is just fixed for a certain number of years. So for example, the 10/1, it is the interest rate's fixed for the first 10 years. And then after that, starting in year 11, the interest rate can adjust once a year. The minimum credit score for these loans is a 680, and the minimum down payment is 5%. The really great thing about these particular loans is that there's no what we call loan level pricing adjustments, meaning that if somebody has a 680 credit score or if they have a 780 credit score, they're getting the same low rate. So there's no rate adjustments on these particular loans. They're also pretty unbeatable rate-wise for doing a second home or vacation home. So the interest rate is going to be a lot lower than doing a conventional loan if you do an ARM on a second home. This particular type of loan is ideal for somebody that maybe is not planning on staying in the home very long or plans to refinance within the first couple years, if interest rates go down. There's also, so the ARM products are, the 100% financing and the ARM products are Chartway's portfolio products, meaning that there are loans. We service them. We don't sell them to the secondary market. So for the ARMs in particular, we can usually make exceptions when it comes to things like loan amount. So if you have somebody that is looking for a luxury home that might be, $1 million or higher as far as purchase price, depending on how much they're putting down, this can be a good option for them, and they don't again have any like jumbo pricing, so they get the same low price for if they're doing a regular loan under the regular conforming limits, or if they're doing a higher jumbo loan. Another option that we have that's really great for some folks is the simultaneous equity loan. So what that is it's a second mortgage that they get at the same time as the first mortgage. This particular product does require that the borrower have at least 10% down of their own funds, and then they can also get an equity loan for that additional 10%. So it's a good way for somebody to avoid mortgage insurance on the loan, or like say for example, if they have a home that they're planning to sell, but they're not actually going to receive the funds for that prior to purchasing the new home, they can do a simultaneous equity loan, get that extra 10%, and then pay it off once they have those funds from the sale of their home. This particular product, they do have a 6-month introductory rate for a home equity line of credit if that's the type of second mortgage that they're doing. So it's nice because that first 6%, it's only a rate of 2.99%. And the simultaneous equity loans, those are only available for primary and second homes. It can't be on an investment property. And then the last product that I wanted to go over that again is one of our portfolio products is the I-10 mortgages. So I-10 stands for Individual Taxpayer Identification Number. These loans are unique because it's for folks that do not have a Social Security number, and they have an I-10 number with the IRS. So it gives us an opportunity to serve additional individuals in our community. The minimum credit score for these is a 680, and the minimum down payment is 5%. And for this particular product, the only options we have available as far as terms would be the same as the adjustable rate mortgages or the ARMs. So they can do anywhere from a 3-1 ARM to a 10-1 ARM. And this particular product is for primary residences only. So I know that was a lot of information. Does anybody have any questions?
I have a question actually.
Sure.
For the last one, do you usually ask for like maybe green card, a copy of green card, or because I remember back in the day when I used to sell real estate in Connecticut, I had a client on a visa, on a work visa,
Mm-hmm.
and so most likely now I don't remember, but maybe she used this kind of loan. I remember that she had a conventional loan.
Yeah, most of the I-10 borrowers that we have usually have either a passport or they'll have like a non-permanent resident ID, or we've even had like the matricular consular IDs, we can accept those as well. So yeah, usually they do not, well, it depends, but sometimes they don't have a traditional, like say, state of Virginia driver's license. It's usually another form of a Class 1 ID that we accept. Any other questions? Anybody online?
You want to tell us a little bit more about the ARMs? I know that in the past those have been pretty successful. We've used those a lot of times.
Sure.
And I like them when we use them where you can do, like if a seller has to sell and buy, and we do the 80-20 principle where the second is the one that they're going to sell. Do you want to share just a little bit about that? Because that's been very helpful when I had clients that use that product.
Sure, yeah. So the ARM loans have definitely been very popular over, especially the last few years with interest rates being a little bit higher, because they typically are anywhere from like a half to sometimes even a full % less than what a conventional fixed would be. So especially in this rate environment, they're pretty popular right now. But yeah, we've done a lot of ARM loans where somebody is buying and selling at the same time. So they, maybe their intention is to put 20% or more down on the new loan, but they just simply don't want to have to sell their current property, before buying the new property. So that way they don't have a contingency on the contract. So yeah, a lot of times they will we call it a 80-10-10, but it basically just means the first mortgage is 80% of the loan amount. The borrower is putting 10% down of their own funds, and then they get a simultaneous equity loan for that additional 10%. So that way, in terms of the first mortgage, they are putting at least 20% down, and they can avoid any sort of mortgage insurance. So that has been a really great option for when you're buying and selling at the same time.
Really quickly, how are the ARM products looking stacked up against the traditional loans right now?
I would say for majority of borrowers, depending on credit score, like right now, the 5-year ARMs are only about 5.75, and if you do a traditional 30-year fixed, you're probably looking at around at least like 6.5, somewhere around there. So it is a big difference in terms of interest rate. So it's a good way to get your rate lower, and the rates with the ARMs, you don't have to buy them down. That's just the rate that you get as long as your credit score is a 680 or higher. So it is definitely a really great option to have a nice low rate without having to buy it down.
Explain how it readjusts.
So depending on which option you go with as far as the loan term, like say for example a 10-1 ARM, it's going to be a 30-year mortgage loan, and the interest rate is going to be fixed for that first 10 years. So it won't adjust at all in the first 10 years. And then after that, starting in year 11, the interest rate does adjust once a year. That's what the 10/1 means. And then at that point, each annual adjustment has a cap on it. So the interest rate, depending on what the market's doing at that time, it can either adjust up as much as 2%, or it can also adjust down as much as 2%. So if you did, like say for example, the 5-1 ARM, it's possible that over 6 years, 7 years, 8 years, you can end up with a much lower interest rate than what you started with, which is nice. There's also a lifetime cap on the loan, so the interest rate can never adjust more than 6% above your starting rate, no matter how bad the market is at the end of that fixed time frame. So it's a pretty safe product in comparison to previous ARMs, like back in 2008 time frame.
But do you see a lot of people using it?
Oh yeah, it's been a very popular product with
Probably
Chartway.
a dozen or so of my clients have
Yeah.
done it in the last few years. It's very safe. It's not your traditional ARM that they had a few years ago, or probably 10 years ago, where they were very, unsafe. Chartway also shelves those loans, so this is an in-house product, which is something that they're very specific about. And they've saved some of our clients a lot of money. Because you don't have to sell to buy, right? And then you pay off that second, which is usually the amount of money that you would have gotten out of your house that you're selling. So you don't have to spend that money to refinance again. So when you're in a situation where you're going to have a significant, let's just call it $100,000 that you're going to get from this house, you don't have to readjust your mortgage after you sold to get that lower payment. You can kind of think about how you're going to adjust it up front so that you have that second, which is so wonderful to not have to refinance again.
Right.
Thinking about it that way. And then for like a lot of our military families or people that aren't going to be here a long time and they're really rate sensitive, right? This is a product where you would want to put people into something like this if they're only going to be here a few years and they're going to be gone.
Yep.
And they maybe don't do a conventional, they don't get a VA loan, or maybe they've already gotten their VA entitlement tied up somewhere else.
And if you compare, like say, the 5.75 on an ARM versus the conventional at, like say, 6.5, if you compare the monthly savings over even a 5-year time span, it's very significant. Yeah. So a lot of people are a little bit hesitant just because it's adjustable rate and they like the idea of the rate being fixed. But the rate is fixed for a certain amount of years, so you just have to kind of get past that adjustable rate fear, yeah, and just realize that, the rate is fixed for a certain number of years. It will not change. And then after that, it's very possible that you could even end up with a lower rate without even having to refinance.
Well, we've all heard that kind of trite statement, which is find the perfect house, marry the house, date the rate, right?
Yes.
And so if we've got clients that are very, again, rate sensitive, and they know that at some point they're gonna refinance, right? And they're looking at the bottom line number, they need to have X amount of payment. We all have had these conversations, right, where we wanna have a client that has the best rate. This is where you kind of go, okay, when you're having these buyer consultations and you're thinking about, how can I win the client, first of all, if you're in a multiple situation where they're interviewing other agents or whatnot, or if you're in a listing where they have to maybe sell and buy, or they're just beginning to shop or whatever, this is how you're gonna win on so many fronts, because you say, hey, look, if we don't have to sell to buy, and we can keep you that in the lowest payment that you want, these are the conversations that you're gonna start having. Then you kind of say, okay, this is how I can put you in touch with this person that's gonna do this for you, and you don't have to refinance. But if they're gonna refinance anyway in the first 7 years, this makes sense, this product makes sense. You just have to be able to articulate it, and Tiffany's really good at being able to explain that on the back end.
Yeah, and the ARM pricing is particularly for second or vacation homes. I mean, it's like unbeatable compared to a 30-year fixed loan in this, like selling it to the secondary market. The pricing of ARMs versus conventional is much more vast in terms of rate comparison versus like a primary. So for second homes, it's a very, very good product rate wise.